Good afternoon, everybody. Thanks for joining us today. Mr. Raheja, Fund Manager of SATCO Growth and Momentum Strategy, will present our investor update for the month of September 2020. Please go ahead, sir.
Hi, good afternoon, everybody. Thank you for joining us on this Thursday afternoon. We at SATCO, as you know, have run a PMS which is called the Growth and Momentum PMS. A lot of people who are today attending this PMS meet our investors. We have some people who are new to us. Very quick breakthrough. SATCO is a full service broking house. It's a mid-tier broking house offering various broking products. The PMS is one of them, which is run by us. We've been doing this for the last 8.5 years. We have a stellar track record. In fact, in terms of PMSs that have been run for such long periods of time, we are among the top 3 at various, on a 5-year basis, inception basis, even on the last 1-year basis, and so on and so forth. We've been reaching out to you, our investors, during such uncertain times and actively trying to tell you what we are doing in the PMS and how we have been able to achieve the performance that we have achieved. As a part of that initiative, we have now decided that every month on the first Friday of the month, we will essentially have a interaction with all of us, all of our investors, to tell them about what's happened in their portfolios in the month that went by, how they performed. You, of course, will be getting in the next 1 or 2 days the portfolio MIS statements as such. But we thought we will tell you how we see things in the market and how what are the things that we have done in our portfolios and how we have performed in the PMS during this period of time. This is going to be a regular interaction with all of you, and today is the first of many as such. So very quickly, let me just jump into our presentation. So we have a very quick presentation. The format is we will very briefly touch about all that has transpired on the economy in the last 1 month, the major news flows. We will discuss what has transpired in the portfolios, what are some of the changes we made. And what we thought is from here on, what we will also do is every such meeting, we will talk about a couple of stocks in our portfolio that we have invested in, to give you a flavor of where your money has been invested and how we see those investments panning out. So, running very quickly, as you know, there have been lots of news items that I'm sure all of you are tracking. This one is something that has been put out by India Ratings, which is a premier rating agency in India. Very clearly, we've seen what has happened to the GDP. We were any which way struggling in the last many years, thanks to the demonetization, the GST implementation, and so on and so forth. So as we got into the COVID, we were already on a downward sloping trend. And the COVID impact and the lockdown impact only acted as a huge, further acceleration to the downtrend. And so for the current year, FY21, the estimate of most agencies has been varying between 9 to 10%. Of course, we had a huge negative of 23.9% in the Q1. The recovery is expected to be, people talked about U, V, and different types of recovery. But the long-term recovery, in our view, is going to be more flattish and long drawn rather than any V-shaped recovery. Of course, the next year, 22, is going to see a big jump, but that's because you're coming on in negative on a very low base as such. So the process of recovery is slow. At the same time, inflation has remained surprisingly high, unlike global economies where the central banks have been able to reduce interest rates to almost near zero. It's become very difficult in India to do the same. So monetary policy has run its course for most of it. Inflation is expected to be closer to 5.1% on an average for the year. Given that, it's going to be very difficult for the Reserve Bank to further reduce rates substantially. You might have, in my view, a maximum of a 0.25% as such. But that is where we think. So that unfortunately does not create a further incentive for manufacturing beyond what they've already got. Further impacting this is going to be the fact that the government is any which way running a huge fiscal deficit. In fact, the fiscal deficit is expected to be close to 8% for the central government and almost 13 to 14% for the state and the central governments combined. Which means there is going to be a huge amount of borrowing that the governments are going to resort to, and which is going to take away a substantial chunk of the liquidity that is there in the markets. So as a result, it looks very difficult to see interest rates coming down dramatically from here in a substantial manner. The economic indicators, as this heat chart shows, are substantially mixed. So while on the other hand, retail transactions done through online have grown by almost 39, 37, 40%, as you can see on the lower part of the left-hand side chart. Tractor sales have done well, reflecting the fact that the rural or the agro economy is doing well thanks to monsoons as such. Again, down as we come on the right-hand side, you see the Manrega job demand and the jobs provided and the number of tenders involved. So all of that is essentially showing that the rural economy has been the savior. Unfortunately, it's not a very large economy from an India perspective, the rural economy. Exports, which is one part of the economy, and imports, as you can see, external trade is yet showing negative. Exports are down 13%, imports are down 26% as of August, and that accounts for a positive current account deficit. Petroleum consumption is down, as you can see at the left-hand side on the top. So essentially what we are seeing is we are seeing pockets of the economy doing well. Manufacturing has come back very strongly in the last couple of months. We can see the PMI manufacturing index is at 52% 52 in August. The numbers today that have come out have indicated in September they've actually gone to 56.8, which is a very big positive. However, counterbalancing that is the fact that the service PMI is yet nowhere close to where it was. If you look at the last line on the right-hand side, you will see that the services PMI, which was at 57.5, is at in February is yet at 41.8. So, which is really reflective of the fact that if you see restaurants are closed, you're seeing malls not seeing footfalls yet. You're seeing entertainment zones being closed, hotels not doing well. So the services economy, which is a large component of the Indian GDP, is yet struggling. The manufacturing GDP is about 25 to 26%, and that has come back. And even that, in our view, is essentially a restocking of channels in anticipation of festival demand in the months ahead. And if that does not transpire as expected, again, we would see manufacturing struggling as such. But for the time being, manufacturing is the positive growth story that we see here. Through all of this, as you can see, The FIIs have in the last few months bought in sizable amounts of money after the outflows of March. But September has been the first month where again we have seen FII flows being negative as such. And you probably see that in the market. The markets have been more or less flattish, going up and then coming down through the month of September as such. So coming to our portfolio, just to reiterate from our last meeting, as we got into this COVID situation, we quickly ran to the drawing board and decided to rejig our portfolio to make it more responsive to the present scenario. So we said, let us look at companies and sectors which will be least affected and will also bounce back the earliest from the current COVID scenario. So what did we do? Immediately we looked at all our list of companies and we removed a lot of companies where there was substantial leverage. We removed companies which had longer working capital cycles. We removed companies which had a very strong retail interface, such as exhibition companies, retail malls, and so on and so forth, from our portfolios. We sort of consolidated our financials. We were holding a substantial amount of financials in our portfolio. We consolidated that to focusing on leadership. So for example, within the banks, we consolidated ourselves to holding the 3 private sector banks who are, in our view, the best placed, who have raised capital at the right time and prices, and who are currently carrying the best quality books, and who also will gain market share at the cost of the other struggling entities. So, we consolidated that within HDFC, ICICI, and Kotak as a part of our portfolio. Mind you, we had a higher holding, which we reduced it down. On the NBFCs, we focused on the market leader as such, because clearly for the NBFCs, there were multiple challenges ahead. In terms of their ability to source and raise capital to sustain this tough period. So we focused on HDFC in the mortgages space, who we think is extremely well placed, and we believe that there is a consolidation theme that is playing out in the HDFC space, where the large are going to get larger and the small are going to gradually struggle, get merged or die out. So we focused on Bajaj Finserv and HDFC as our 2 largest holdings out there. We already held insurance in the form of SBI Life. We think it's a great business. It's a business which generates over 24-25%, 20% plus ROCs. And these businesses typically are have large moats. And as we saw during this period, and in the previous chart also, I would sort of like to highlight to you, if I were to go back 1-2 slides, you can see that the gross premium for the life business has grown 15% in the last couple of months. So and within this space, we thought SBI has a great franchise and trades at very attractive valuations. Mind you, we saw his numbers compare very well to HDFC Life, but at a substantial discount to HDFC Life. So we focused on leadership in the financial portfolio and strong balance sheets. We already held pharmaceuticals in our portfolio, and we really did not sort of jump in and react to this. Within the pharmaceutical space, we already owned companies like IOL Chemicals and Granules India. However, we did add JV Chemicals during this last 6 months to our portfolio. We found a great company, and we will talk about this a little later, on the verge of a great transaction that was to take place. And I will discuss this when we talk about a few of our companies later. So we put 11.5% exposure to this area. We in the chemical space, we already held Deepak Nitrite, Fairchem Specialty in our portfolio. Mind you, these companies we were holding before chemicals became the flavor of the month in our portfolio. We only further increased our weightage during this time. Yes, we did add GMM Pfaudler, and technically it's not a chemical company. However, considering the fact that GMM is essentially the largest manufacturer of equipment which is used by chemicals, pharmaceuticals, and agrochemical companies. And there is a huge amount of capex and expansion that is happening in this space. And GMM in India at least has a 50% plus market share in this space. So in the panic of March, and we actually added GMM to our portfolio. And now in the recent OFS, we further increased our position there as such. Agrochemical again was something that we added to our portfolio. We bought in Dhanuka and insecticides. UPL as a company is something that we were already owning before the crisis. But seeing the state of the agri economy and the demand, we bought in Dhanuka and insecticides. Again, companies were extremely strong with huge distribution reach. Gas. This has been one of our favorite sectors for the last many years. Mainly led by the regulatory framework moving in their favor. Gas is a clean fuel and is seeing more and more usage starting to take place. So we owned Indraprastha and Gujarat Gas, and we continue to own them. They have been businesses which are quasi-monopolies with strong entry barriers and moats as such, and direct interaction with end customers. Weber Global has been one of our huge winners in this last 1 year and even in this last 6 months. It's a company which essentially, I would call it, operates on digital commerce space, mainly in the US and UK. Business has a huge, huge return ratios. His ROCs are in excess of 40%, pays out huge dividends, and did a buyback recently as such. So if you really look at our portfolio, the way we had structured it, almost 40% of our portfolio, which we comprise of more than 40% in pharma, chemical, agrochemical, gas, is what I call as COVID-proof portfolio. Vaibhav is not got any impact on the Indian market. Then we bought into Bharti, which of course has not done very well for us, but we continue to be very positive on them. So these stocks, we believe, are immune from, to a large extent, that even if COVID continues at the current rate of spread, these companies will continue to do well as such. So at one level, we created what is called as COVID-proof companies or COVID-proof sectors in our portfolio. On the other hand, we consolidated in the financials in leadership. We also did a very unusual thing. We had bought gold in our portfolio through the Nippon Gold Bees in March, April, when markets were very volatile. Rather than sit on cash, we said we will invest in gold, and that has also worked out very well for us. Our portfolio companies, at a time when the GDP is negative, when the index companies have given negative returns, have delivered 24% growth in the first quarter, as can be seen here. These are the non-financials. Our financials have delivered 15% growth during this period. Now, if you look at the last month, now I come down to the last month, and I will, sorry, I should go behind. Okay. So in the last month, there were, our portfolio was positive 1.8% when the markets were negative minus 0.3% as such. So it was from March when we look at it, it was another month. Now this has been almost the 5th or 6th month when we have been outperforming the index. What is it that was some of the attributing factors in our portfolio and contributed to this? In the month of September specifically, Granules India was one of our companies which was up 22% in September. JB Chemicals up 27.5%, Deepak Nitrite up 20%. These are three of our large winners in the month of September. Against that, we had two major laggards. One was GMM Pfaudler, which we are making money for all investors. However, in the month of September, it was a negative. And luckily for us, we in April had not been able to get our full quantity because the stock ran up very quickly. And then we desisted from buying, but we increased our holding in GMM with the recent OFS that was announced, and which made news for all the right or wrong reasons. And Bharti, which was down 18%. So these are two of the companies which kind of weighed down our portfolio during this month. I will also now get into and talk about what was the new company that we introduced into our portfolio. So in the month of September, we added ABB Power. ABB Power is an offshoot from ABB India, and it got listed only in March 20 recently. Here, the shareholders of ABB were given 1 share of Power India, as the company is now called, for every 5 shares they held. And this company is now owned by Hitachi as such, because ABB sold this business to Hitachi. Company so it's an MNC company with almost a majority of almost 65-70% ownership by Hitachi. They are the #1 player in this field, and they have grown faster than the market. They are essentially a transmission, electric transmission EPC company, if you were to call it. But they've also built a digital products business on automation and software and services. And they create innovative solutions for the entire power value chain. So they essentially help power companies to become more and more efficient as such. Very low amount of debt, and ROC is in excess of 20% as such. Hitachi is the #1 player in the transmission and distribution systems business. Essentially, their order book currently is in excess of 1.5 times trailing 12-month revenues of this. And so there's huge visibility that they have on the business. The opportunity is huge in terms of the railway electrification that has to take place till 2023, and the demand for electric automotives. Also the entire green corridor, that infrastructure that is being set up for renewable energy producers, the power grid expansion. So there is the Vision 2025 that the company has put in forth shows that there is tremendous amount of revenue growth visibility for the company. Also further, giving us confidence is that Hitachi has twice made an open offer which has failed, because the offer has been as per SEBI guidelines, and it has been at a lower price to the market price as such. So this is a new addition, and most importantly, we were buying this MNC company at 20 times earnings, which is, in my view, very, very cheap as such. I think what also we said we will now do is, as I said, in every such interaction, we will have 2 companies of ours which we will discuss and tell you about, to make you and give you a flavor of why we are invested in them and what we see from each of these companies. So today we are going to discuss about GMM Pfaudler and JB Chemicals. GMM Pfaudler, as you can see, is year to date has delivered 113% return from January to now, while the index is down 5.4%. We invested in GMM Pfaudler around April, mid, first week to mid, say around 2,700 in our portfolios. Thereupon we desisted from buying anything further because the stock really had a very fast and sharp run. Recently, GMM did an OFS at a substantial discounted price of 3,500, which saw the sharp correction in the stock. And we participated in the OFS and increased our holding, making our average acquisition cost go up to 2,976 in our portfolios. So what is GMM? So GMM is basically a leading supplier of engineered equipment and systems in the chemical and pharmaceutical business. The chemical and pharmaceutical business, as you know, is doing exceedingly well, thanks led by the even getting into the crisis, led by the environmental norms tightening in China, and B, post that by suppliers wanting to diversify themselves from China. So if you look across the pharma value chain, if you look across the chemical chain in India, all the companies are in an expansionary or a growth mode. So GMM is a very old company, set up by the Patel family. The Pfaudler Inc. From Europe acquired a 40% stake, and which was increased to 51 in 1999. This company has a 55% market share in this business. If you talk to anybody in the chemical business, their first port of call, whenever they are ordering reactors and glass-lined reactors, is GMM. And GMM's product also is quoted at a substantial premium to its next competitor as such. Its 5-year revenue growth has been 14% CAGR, and EBITDA growth 26% and profit growth 30% as such. Recently, even GMM, as a part of its growth plan, acquired 2 facilities in India. They had the nearest competitor, a company called Swiss Glass, which ran by the name of Dawnay Process Systems, which they acquired in Hyderabad. And they did a very interesting transaction. Pfaudler Inc., the parent company, actually was owned by private equity players. The private equity players wanted to encash and move out. And the Indian local promoter went and acquired its parent. So it's pretty unique and a first of its kind, which gives GMM access to facilities in 7 countries, 3 of them modern facilities, and all of this happened at a price which was extremely reasonable. So suddenly you have a scenario where GMM, which is a 700 crore turnover company, is this year going to have, on a consolidated basis, a 2,000 crore company. And although the profitability of Pfaudler is lower, but with the promoter family now acquiring and it being one company, a lot of work will be moved to India, and that is expected to increase the profitability even of the parent further. Again, this is something that I shared with you. The right-hand lower corner tells you extremely competitive business with 29-30% return on capital ratios for the last many years as such. When you look at GMM on a trailing 12-month basis, this of course only factors in the standalone GMM business. On a consolidated basis, these numbers are far higher now. This EBITDA that you look at 111 crores is going to be 260 crores for the current year. And the profitability is going to be almost, much more than doubling, almost close to 170, 180 crores in our view for the current year. So, so when you look at it in conjunction with that, it looks at 30 times earnings. 30 times earnings on a consolidated basis compares very well with Swiss Glasgow, HLE Glasgow, with their competitor, which is at 60 times, and AIA Engineering. Now, why do these companies trade at these valuations? It's because these companies are market leaders. These companies are first port of calls for any of their customers, and they are able to command a pricing premium. To sum up, we believe that GMM is a market leader. It has projected revenues is going to be 2,000 crores with an EBITDA of 13% or 260 crores. By 24, the management has guided to 2,800 crores with a 16% EBITDA, which is that EBITDA jump or profitability jump that I talked to you about, which makes it 450 crores of EBITDA margin coming in place. The company trades at about 5,000 crores, so it's about 10 or 11 times EBITDA, which if you were to look across for all large companies is pretty much par for the course. And that's one of the reasons we subscribe to the OFS at these lower prices. Strong cash generation, ROCs, ROEs in excess of 20-24%. JB Chemicals. JB Chemicals is a very old company run by the Modi family, a very well-established company, promoters with very, very high reputation and pedigree. The company has delivered 130% year-to-date growth this year. We entered it, as you can see, again in April at about 476, and it has almost doubled for us also from then. And we further added at 682 just when a transaction took place where one of the world's largest PE manufacturers took this company over as such. So GMM, essentially, if I were to tell you, has two main business segments. It's the domestic India formulations business, which is about 43% of its business and 50% of its operating profits. This business has grown at 14% and faster than the market. And this has been led by the fact that two main segments, which is cardiovascular and gastrointestinal, have the largest contributors. Its brands, if you can see, whether it's Cilacar, Rantac, Metrogyl, and Nicardia, some of you must have heard of these, are all market leaders, if you can see. Metrogyl has a 65% market share, Nicardia has a 70% market share, Cilacar is a 50%, and Rantac is 22%. And now they're launching, mind you, almost most of them are under price control. In case of a few of them, price control has recently enabled them to increase prices, all of which is not yet reflected in their earnings. These brands, so what has the company done? Instead of spread itself thin, it has focused on these top 4 brands who account for 80 to 85% of its business as such. The export business is something that they entered in the last many years, mainly focused on markets such as the emerging markets such as Southeast Asia, Africa, Gulf, Latin America. That has grown at 11% CAGR for them. US business, they have a small portfolio of 14 ANDAs. Their whole focus is now going to be on the US business with their new parent coming in place. Most importantly, if you look at the bottom right-hand corner, this is the company which has been generating very strong cash flows and payouts. If you take the last 3 years or 4 years, its free cash flow has gone from 81 to 112 to 149 to 275. When we bought the business, out of its capital employed of 1,500 crores, 400 crores was cash. So almost 30% plus was close to cash as such. And it's been paying out very handsomely in the form of dividends and buybacks to shareholders. In July, the promoter group sold their stake to KKR. KKR, as you know, is an American PE fund. It's one of the largest PE funds in the world with over $150 billion globally under management. It's very interesting that PE funds have got very, very active in the chemicals and the pharmaceutical space in the recent past. And it's a manifestation of the promise that they see of India becoming larger in this segment as such. And you really look at our portfolio, we also have been owning the chemicals and pharmaceuticals, seeing that same trend earlier as such. The PE fund has now brought in a professional CEO, Nikhil Chopra from Cipla. The chairman is Mr. Ranjit Sahani, who used to be the chairman of Novartis in India. My belief is that they are now going to drive growth in this company. This company, if you could see, had a 14-15% growth, which we think is now going to accelerate substantially from here. And they will also open to ideas of looking at acquisitions and growing as such. When we look at it from a PE basis, it's on par after the run-up with most of its peers. But we think with the new management, the new promoter, this is indeed a very exciting phase for the business. So, like I mentioned to you, strong domestic performance, growing export business, debt-free balance sheet, new management in place, compelling valuations. Do we think this company can double its earnings in the next 3 to 4 years? The answer is yes. And that, if you remember, is the basic hypothesis of the type of companies we try to invest in. Companies who have strong growth and visibility and who are looking to double their earnings over the next 4 to 5 years. So this is two of the companies that we own in our portfolio that I discussed. Next month, we will discuss a few more of our companies as such. Once again, let me reiterate to you the performance. We have from 2012 consistently outperformed, except for 2018, where we had also informed you about the fact that we had a higher exposure to the financial space, which hit us. And all of this, if you really look at it over this 8.5 year period, even 2018, it was 1 month of September 2018 where we took a bad hit because we had a high exposure to the financial sector. But otherwise, it's been a consistent long-term performance demonstrated where we have been able to deliver for our investors. Since its inception, absolute numbers 809, compounded 28.7 over this period of time. That's as far as I have to share, and I would like to open it up for Q&A.
Thanks, Nitin. I invite participants to put in their questions to the Q&A box located below. Nitin, we have already questions lined up, so let's get into it. The first question comes in. SBI Life is likely to acquire future insurance. Right. Will it not drain margins? Also, SBI Life does not have non-par products to the best of my knowledge. All competitions have non-par products.
Sure. So you're right. Will it drain margins? If you look at SBI Life over the last many years, they've run a business which has been very, very consistent in terms of its ratios. Even the new business acquisition has been very, very profitable. The share of new business acquisition has in fact helped them to grow their margins over the last few years. In terms of size of business, if you look at it, they're almost close to HDFC Life. Their margins are also very, very close to HDFC Life as such. So will it temporarily impact it? Possibly. But knowing the management's focus also on margin, I think it will come back to where they historically have been. Varun, would you like to add to this?
Yeah.
Let me just introduce my colleague Varun, who is one of our analysts in the PMS.
So we do have information on this. SBI Life has a much smaller share of non-par products compared to HDFC and even ICICI Prudential Life. but it is there. It is in the low single. It's in the low double digits, 15 to 16%. Number one. Secondly, in a low interest rate environment, I would not be too worried about non-par products being a small part of my portfolio. Regarding this future, the Mr. Biani wants to offload the insurance companies to SBI. I think it's referring to a news article which was there about a week ago in the papers. I would like to analyze the deal more before I say anything. These deals are happening a lot now. It looks like there's some consolidation which might start. I would like to analyze this before I actually come to a conclusion on whether we will continue to hold the stock or not.
Jay.
All right, yeah. Moving to the next question from Mr. Iyer. Why no IT stocks? Don't you think due to work from home, IT is a big gainer? We are doing this webinar via Zoom.
Okay. So you're absolutely right, Mr. Iyer. We are looking to add IT. To be very honest with you, as I said, when we got into this whole, our ethos or our investment philosophy has always been that we will be investing and buying into companies who are going to double their earnings every 4 years. And this was hitherto when Indian GDP was growing, the nominal GDP was growing at 12%, 13%. So we were looking at companies who will double in every 4 years, which translates into a 19.8% sort of a CAGR number. IT, unfortunately, did not fit into that criteria for us. However, now we are also cognizant of the fact that the GDP growth number has come down substantially, and it's going to take time to recover. Also, IT is among the segments which is again relatively COVID-proof. So yes, we are looking to invest into IT companies. In fact, just today morning, we had our investment committee meeting where we discussed this very topic. So we did miss the first round, I must confess. However, that has not really impacted our performance because despite not having IT, we have not only outperformed our benchmark, but we have outperformed most of our peers. In fact, for the month of July, August, and September numbers have not yet come out. We have been among the top 3 PMSs. So yes, while I agree, and to your point, we are looking at IT even now because we think IT is a long-term story, and maybe this whole digital cloud work play is going to accelerate the IT spending and improve the growth rates of IT companies as such. And if you really see, the market actually has also re-rated them in that expectations. We haven't seen those growth rates yet, but fortunately for us, from our criteria perspective, when the overall economy slows down, we also become a little more lenient from a perspective. Now, it's realistically speaking, instead of looking at a 4-year doubling, we look at a 5-year doubling, and maybe that's where IT would easily fit in with those numbers.
Right. The next question is from Mr. Narendra. With so much debt and low ARPUs, how do you expect Airtel to make a positive surprise in the portfolio?
So, you see the point, the reason why we invested in Airtel was precisely the reason where the previous questioner came from, of work from home. So what has happened in the last few days, the data consumption has gone up, voice output has gone up. Also in the industry, there are only 3 players, out of which there are really only 2 very, very strong players. The third player is looking weak and needs some support to survive. Otherwise, I don't think it will be able to survive also. At the same time, Bharti has come about and has guided to the fact that they believe the ARPUs will go up from 200 rupees to 300 rupees in the next 1.5 year time. Now, all costs being same, a 100 rupee jump in ARPU can have a huge impact on profitability as such. And now, don't forget that even Jio has now answerable. Jio hitherto was never answerable. It was a subsidiary whose P&L was hidden within the main parent's balance sheet. But now with almost 20% plus stake given away to investors, Jio becomes liable to answer for profitability. So I don't think that they are going to play this pricing game for long. Even the recent development on post-paid tariffs that was there, which was the immediate trigger for Bharti getting re-rated, was a very nice marketing ploy, because when analysts actually went back to the table and analyzed it, they realized that it doesn't really translate into lower tariffs as such. So our view is that yes, Bharti does have low high debt, but it's again a COVID-proof portfolio in a consolidating industry, and consolidating industry always brings back pricing power. And when that happens, you will see Bharti's profits come back very strongly.
The next question is from Mr. Gavri. The question is on GMM Pfaudler. We bought GMM at 2,700 and it touched 7,000 in a short time. Did we sell some part of it or stay put? What's the exit strategy from stocks? I think it's a more generic question on exit strategy as well as GMM.
Sure. So our exit strategy on stocks has been that, as I said, we typically look at companies who are doubling themselves every 4 or 5 years. Now, if a lot of that gets discounted far early, and we see that even if this company were to double from here, the stock will not give us the same level of return. We look for alternatives. In the meantime, we might continue holding some of these stocks if they are the top quality names and so on and so forth. So GMM Pfaudler, you're right, at 7,000, we should have probably exited, and in retrospect, it looks very hunky-dory. But however, don't forget that there are enough and more companies, multinational companies in India, who trade at valuations in excess of 70 and 80 times earnings, and have continued to remain expensive and continued to deliver returns for shareholders, right? Now, if GMM wouldn't have, so when GMM bought over its parent, on a consol basis, even at a price of 7,000, it was trading at about 9,000 crore market cap. At 9,000 crores of market cap, on a combined EBITDA of 450 crores, it would have been a 20 times future EV EBITDA. It's not very unusual if you go around and look at MNCs to be trading in that kind of a band, and so on and so forth. The fact that they announced, they owned almost 70% plus of the company at that point of time. So when they went out and tried to, because the promoter family also was investing in the Pfaudler Inc. So when they tried to gauge the market from institutional and they wanted to get global investors, they found that 3,500 is where the investor demand really came in. That's when they announced the OFS, and that was a trigger for, probably if the OFS was not announced, the stock would have remained maybe not at 7,000, but maybe have you closer to 6,000, and so on and so forth. Yes, but so in retrospect, if you ask me, should I have sold? The answer is yes, but look, we are always wiser in hindsight, right? And further, GMM was a small portion of our portfolio. Like I mentioned, when we got in early, the stock ran up, so we desisted from buying further as such. So we had hardly a 2% weightage. So from that perspective, we believe that we will continue to hold it because it's a quality stock and which will continue to do well over the next 3-4 years.
The next question is from Mr. Iyer. Why is ITC falling? Do you see value here?
So, the point is that I have tracked ITC for a number of years, and we've internally looked at ITC also. At one point of time, even we bought ITC at some time in the past. My belief is ITC is a great business as such, right? However, for some strange reason, it's not a great business from a shareholder perspective, because they have never ever shared profits with shareholders. They have a balance sheet which is sitting on over 40,000 crores of cash. Why are they sitting on so much cash if the business is generating cash year on year? Why can't they distribute the cash? Why can't they do a buyback? Why can't they pay out handsome dividends? So also what has happened is, from a huge cash business, they've invested in all other businesses of theirs, whether it's the hotel business, whether it's the paper business, whether it's the FMCG business. These businesses have grown in terms of size of turnover, but they are nowhere close in terms of size of profitability. So they've not been able to make good profits in any of these companies. One. So it primarily remains a cigarette business. In the cigarette business, if you look at globally, in terms of how cigarette businesses have got valued, they are not very far off from that in terms of the valuation. If you look in the West as such, primarily because the cigarette is regarded as a business which is against health, which is a sin business, and so on and so forth. So in terms of the cigarette business, they are almost valued in par with their global counterparts. And we, as I said, from a FMCG business perspective, they don't share the money. Only this year they've announced that they will start distributing 80% of profits. So one has to see, whether they actually start through, giving out all the cash. That's the only time I will believe that ITC is worth looking at, because otherwise it's pretty much run like a closed club where shareholders have never been taken care of.
I think the next question is from Mr. Nathan. How do you see US elections impact October-November performance, and how do you plan to hedge this risk?
So how do you see US elections impacting September, October? September is over, right?
October-November.
Okay. So frankly speaking, I think we are going to be in choppy waters in the shorter term. Frankly, from our perspective, the short term 1 or 2 months, what happens to the US really doesn't impact the way we look at our portfolios. Please understand, we are not investing in markets. We are investing in businesses. We are investing in companies. We are investing in companies who have A, very strong managements, B, who run very good businesses in terms of return profiles, the ROCs, the EBITDA, the profitability of the business. C, they are businesses which have market leadership. Now, I'm not going to trade in and trade out of these businesses for short-term volatility as such. So further, from a PMS perspective, please understand, we are not allowed leverage to be used on our portfolios as such. Frankly speaking, if you really look at the longer term outlook, October or November post this, in December, we'll be looking back and saying, did it really matter what we did? So the point is that if you're a trader with a short-term viewpoint, if you're carrying a derivative position which has an expiry on October or November, you should be very worried in terms of how you're going to manage that position, because you have a very unusual situation at present. You are seeing volatility being lower than what it should be. So, most traders in India are always selling volatility. And if volatility spikes, they're going to lose money. So if you're a short-term trader looking at October expiry or November, you should be worried. But from our perspective, I think this short-term volatility really does not, as long as it does not impact the performance. Yes, if I was holding an IT stock and whoever starts making noise out there that we're not going to allow Indian IT companies to service, which is something which, they become the favorite whipping boy for all presidents who come there. Surely that can have an impact, but I don't think from our companies there's going to be too much of an impact.
Right. Nitin, that was the last question. I invite participants to please give us your feedback through the polling mechanism. Nitin, you may give your closing comments.
So, are we through with the questions, Jay?
Yeah, we are done with the Q&A.
Okay. Good. So thank you, gentlemen, for giving us your time. Like I mentioned to you, we are running portfolios for the long term. Our returns have been long term, and they've been consistent. Because we don't try to time the next quarter, we don't try to time the next month in our portfolios. We are not a broker's delight. We continue to believe that India will come back. It will take a little longer time. Our endeavor as portfolio managers is to try and identify companies who will do well during such periods of time and ride that. We believe that if we are able to do that, we will be able to continue delivering the outperformance that we have done. That's because one of the big advantages we as a PMS enjoy is that we focus on having only about 20 to 24 companies in our portfolio as such. So which means every time we invest, we put a meaningful chunk into our investment, because investment ideas are difficult to come by on a daily basis. Vis-a-vis a mutual fund, which also tries to identify the same, but unfortunately they carry portfolios of 60, 70 companies. So typically the impact, if a good company does well, the impact on the overall portfolio is not as pronounced as it is in the case of a PMS. We know that there is going to be short-term choppiness considering the current state of the Indian economy. But we think we are nimble. We think our companies are well positioned to meet the challenges. They have managements who will clearly have shown and continue to show their agility and ability to manage these challenges. So we feel good about our portfolio. We have an independent committee which vets this for us and gives us feedback. We promise you that we will continue to do what we have been doing in the last many years. Thank you.